Let's have a look at the difference between input and output VAT. VAT is an indirect tax that is levied at 15% on almost all products and services. And for now until the end of April, VAT would be still at 15%. And then from the 1st of May 2025 until the 31st of March 2026, VAT will be 15.5%. And then starting from the 1st of April 2026 until further notice, VAT will be 16%. They'll have a budget speech when this will change if it changes. So when assets, expenses, inventory and services are purchased and paid for, it means that the supply will come into the business. VAT is charged on such transactions and is deemed as input VAT and is claimable from SARS. In return, when supplies are sold, they leave the business entity. The VAT charged on such transactions is deemed as output VAT and should be paid to SARS. For any business to claim or pay VAT, it has to register as a VAT vendor in South Africa. And the volume of turnover will determine if a business should or should not register as a VAT vendor. A business entity must register as a VAT vendor with SARS if they earn or expected to earn $1 million or more from sales of taxable supplies in a period of 12 months. And then a business entity can volunteer to register as a VAT vendor if they earn between 50,000 and $1 million, and a business may not register as a VAT vendor with SARS if they earn less than 50,000 within that period of a year. Although VAT has an indirect influence on the price of supplies bought and sold by a business entity, it should be noted that all supplies in South Africa can be categorized into three groups. We have standard rated supplies, which is where the input VAT is 15% and the output VAT is 15%. And examples of this would be inventory, motor vehicle, furniture, and equipment. Then we also have zero rated supply, and even though it says zero rated supply, you should not get confused because input VAT is still 15%, but output VAT is 0%. And these examples of this can be fruits, vegetables, brown bread, eggs, and milk. You'll see on your little slip that it says 0% VAT. Then we have exempt supplies, and this is where input VAT is 0 as well as output VAT is 0. And examples of this is educational services or residential rental accommodation or public roads and rail transport. So now the big question, how do we calculate VAT? So if they say the amount already includes VAT, we know that VAT is already in that amount and we just want to know what the portion of VAT is. So for that we say the amount inclusive of VAT multiplied by 15 and divided by 115. And remember, this change as the VAT changes. So for now it's 15 divided by 115, later it will be 15.5 divided by 115.5, and then 16 divided by 116. So just keep that in mind. So let's look at an example. Bright Gym pays electricity of 20,000. We know the VAT is already inclusive of that. So we say 20,000 multiplied by 15 divided by 115, and 2,608 rand and 70 cents is what the VAT would be on that transaction. Where when it's VAT exclusive, we know that there isn't VAT added yet, so we need to add that VAT. So we'll take the amount will multiply that by 15 and divide it by 100. And again, just remember, this will change depending on the period we're in and where the VAT is. So let's look at an example. Jim pays salaries of 150,000, multiply by 15, divide that by 100, and that is 22,500 rand. So, in order to know what we should pay to SARS, we'll say output VAT less input VAT, which is 19,000 rand, 19,891 rand and 30 cents. That must be paid to SARS as VAT output VAT was greater than input VAT. Since we know how to calculate VAT, it's important to understand how VAT will be accounted for in the books of a business. From our current understanding, we know that input VAT is claimable from SARS, while output VAT is payable to SARS. We can take our current understanding even further by stating that input VAT will result in a future inflow of economic benefits, while output VAT will result in a future outflow of economic benefits. Hence, input VAT can be seen as an asset, and an asset get more on the debit side, while an output VAT can be seen as a liability, and we all know that the liability gets more on the credit side. At the end of each month, all the input and all the output will be taken into the VAT control account into the ledger to determine the net amount that the business entity should pay. If the VAT control has a credit balance brought down, it means that the business entity will pay VAT to SARS. In return, if the VAT control amount has a debit balance brought down, it means that the business entity should claim VAT from SARS. Thank you so much for watching, and let me know if you have any questions.